Today what we're going to be doing is we're going to be remembering what has been happening over the last 20 years in the shopping center industry. And we're going to try and see what are those trends we believe will carry on, and what are new trends which we can see are beginning and will actually be regulators of our industry for the next 20 years. And perhaps even, we might actually say there may be one or two new trends which haven't yet appeared, which might do so. So first of all, Jaap, if I could ask you, from the point of view of lifestyle, what have you seen in the last 20 years?
If I look back over the last 20 years, it's just over 20 years ago that I returned from the United States, where I lived for a short while. And at that time, coming back in the Netherlands, life was sort of maybe traditional, peaceful in terms of looking at shopping center business and retailing. During the week, you went to the grocer and the butcher and whatever, and in the weekends, on Saturday afternoons, you were buying a bit of fashion every now and then, and that was a sort of very traditional pattern. I think what has happened over time, just looking forward a little bit, in the course of the 90s, I think we've seen the first indications that our way of shopping would change, with the first signals that internet became a bit of a force. I remember the nervousness of the late 90s. We had a sort of hype about everything that had to do with computers and IT systems around the year 2000. We had a bit of an IT bubble and also a bit of an IT crash in the early part of the first decade of the current century. And then if you visited conferences, everybody would say, you know, it's not that bad, you know, internet retail, it will not really take off. So there was a sort of relief in the industry. And I think it was a little bit back to normal, and we started to sleep. And then, of course, the crash came of this 2007, 2008. And today we know that life is completely different. And in terms of lifestyle, operating, households, demographics, our world is totally upside down.
We are spending a tremendous amount of capital on our existing assets. You know, the number of new malls that are being built in the States, you can probably count on one hand, where 20 years ago there could be 10 or 15 that were being built on an annual basis. So for us, it's examining our, and when I say us, I'm talking about the majority of the REITs. We're spending capital on our existing assets. It's less risk because we have an idea of what will succeed, what doesn't. We are the beneficiary of some great global, retailers that help us with our expansions or re-merchandising, whether it's Zara, H&M, Forever 21, Lego. Now Uniqlo is making a presence in the States. So for us, it's not about new mall growth. It is about redefining who we are and taking our existing assets and raising them to a point where they can actually meet the potential of the respective market.
Yeah, but if I may, you don't grow all of your assets. You choose the one assets that you grow, that you spend money on.
You do.
Well, it's the same thing. I mean, when I say it's not only about greenfield development, it's about spending the money on extensions, on the right locations at the expense of other ones.
No, you're correct.
Yeah.
Yes, it's a.
For me, the big surprise is, if I go to the US, but correct me when I'm wrong, Alan, that the market there is still very much, the shopping center market still very much determined, or the layout of shopping centers is determined by the existence of department stores. Of course, the new generation of lifestyle centers, which are open air and not covered and whatever, that's a different breed. But if you look at the traditional centers with 6 or 7 different department store chains still existing, where in Europe you've seen them virtually dying. There are still a few left, but not many of them. And if you look at the number that are really healthy, it's quite limited. So I think we are also forced from creating the sort of traditional shopping schemes based on 2 or 3 major anchors, and in between you are running up and down. That concept is gone. We have to create an interesting business environment for every retailer. And in a shopping center today, if you look at for Radunia or whatever in Poland that we are developing now, one of the conditions of the bank was that we had agreed terms with 8 anchors. And the anchors are the supermarket, and it is the cinema, and it is the food court, and it is, sorry, it's 4 major retail fashion chains. I mean, it adds up to a sort of interesting climate, which is much more spread out than the traditional polarized structure of shopping centers.
I would agree with you, but what's happening in the States also is with the demise of many of the anchors. I mean, we take a look at Sears. Sears right now is, from my vantage point, in the real estate business. But when you lose a department store, what we're doing is we're either upgrading that department store to another use. For example, we bought 11 Sears locations. 3 of those Sears locations we converted to 3 Nordstroms. So if you had a center that was a Sears and Penny's and Macy's, now you had a Macy's, Nordstrom's, and Penny's. So you're able to upgrade it. But more importantly, we're also taking these anchors and we're redemising them, either knocking them down, redemising, to your point, adding entertainment, adding food, adding what is considered non-traditional retail to enhance the customer's experience in the marketplace. So that's going on as well.
We are in a perpetual change in our business, and the latest trend is to see the growth of people like Primark, which do an extraordinary development recently. So you see, our business is extraordinary. There are new players all the time, and the name of the game is really to take the wave at the right moment and to make sure we anticipate the trends. That has consequences on the way we work with those retailers, in the way we manage those centers and own those centers. But at the root of that are the changes in the retail itself, which are still very, very important.
If you talk about US and Europe in terms of combined marketplaces, I don't think that's going to make sense. If you go to ICC in Las Vegas, and some of you may do, it's a complete American story. And if you want to find a European retailer, if you look very carefully, maybe you may find 5, sort of maximum. So I think the financial markets have already sort of integrated. The real estate markets do not, and I can't see that's going to happen short term.
And I would just add that the one area that I think impacts our investment decisions going forward is really going to be the health of the retailers. And that's the one concern I have. And can they sustain growth? Can they sustain enough growth, which will translate into productivity, which will translate ultimately to the types of rents that we can expect? That, to me, is my biggest concern. You have macro elements, you have political factors that are out there, but unless the retail community can reinvent themselves as well, because a lot of this is being pushed on the owners, but I challenge the retailers to try to reinvent themselves as well, because there's, at least in the States, there's a lot of sameness there. There's not a lot of differentiation. One of the reasons we're here, this is our first MAPIC, is to try to understand what else, to get visibility to other retailers that are, available who might be interested in coming to the States. But unless the retail community starts to understand their business and continue to reinvent themselves and continue to improve their customer experience, within the marketplace, I think there's going to be some real volatility in the investment market, in my opinion.